Did you know that 78% of millionaires created their wealth during economic downturns? That's right. When markets are crashing, the smartest investors see opportunities everywhere. Today I'm showing you the 5 specific strategies that turned market crashes into gold mines for everyday investors. Think of it like a massive clearance sale where quality assets are suddenly available at bargain prices. If you've been watching your portfolio drop and feeling that knot in your stomach, you're about to see market chaos in a totally different light. By understanding what the wealthy already know, you'll be prepared for the next inevitable downturn. Meet Alex, the accidental opportunity hunter. Remember that gut-wrenching feeling when the market nosedived 30% in March 2020? While your social feeds were flooded with panic memes and your coworkers were frantically checking their 401k, every 15 minutes, Alex was surprisingly chill. Not because she's some Wall Street prodigy with insider trading tips, but because for her, this financial horror movie was actually a rerun. Let me introduce you to Alex, a totally normal 26-year-old public school teacher who is still drowning in $32,000 of student debt when the 2008 financial crisis hit like a wrecking ball. She had just started contributing to her 401k the year before, feeling pretty grown-up about her responsible financial choices. Then boom, market crash. Her tiny retirement account was suddenly worth about half of what it had been. Her teacher's lounge transformed into financial panic central. Her coworkers gulped bad coffee while frantically calling advisors and moving everything to cash. "I'm not losing another penny of my money in this scam," her mentor teacher announced, proudly showing Alex her portfolio liquidation confirmation. Alex took a completely different approach. Instead of pulling her money out, she marched into HR and increased her 401k contributions from 5% to 15% of her teacher's salary, a move that seemed absolutely bonkers to everyone around her. Her roommate questioned her sanity when Alex explained why they needed to cut their cable. "You're throwing good money after bad," her dad warned during their weekly call. Even her principal took her aside to talk some sense into her. Meanwhile, Alex tightened her budget dramatically. She ate simple meals at home, skipped the teacher conference in Chicago, sent a card instead of attending a destination wedding, and became the friend who always suggested hanging out at her place instead of trying expensive restaurants. Date nights transformed into walks in the park with packed sandwiches. Her financial priorities were crystal clear, even when uncomfortable. What Alex grasped, that her colleagues missed, was both simple and counterintuitive. Market crashes are predictable parts of the economic cycle. While everyone else saw a broken system, Alex saw the S&P 500 as a designer store with a 40% off flash sale. The same quality items were suddenly available at drastically reduced prices, and she was grabbing everything she could afford. While financial news ran apocalyptic graphics with bears eating dollar signs, Alex quietly purchased index funds at bargain prices. Her automatic contributions bought more shares with each paycheck as prices kept dropping. She wasn't trying to time the bottom. She was consistently showing up to the sale, filling her cart with discounted assets. The magic unfolded when markets eventually recovered. Because Alex had accumulated so many shares at rock-bottom prices, each small market increase dramatically boosted her portfolio's value. 3 years post-crash, her account nearly tripled from $8,000 to over $23,000. Meanwhile, her cash-switching coworkers remained paralyzed, waiting for an all-clear signal that never felt convincing enough. "I'll get back in when things stabilize," they kept saying as the market climbed without them. The problem was, by the time things felt stable, the biggest gains had already happened. By 2023, 15 years after that first crash, Alex's modest investments had grown to over $120,000. Her seemingly reckless decision during market chaos had generated enough money to eliminate her student debt and put a down payment on a small condo near her school. When the 2020 COVID crash triggered another market freefall, Alex barely flinched. She'd seen this movie before. While her Instagram filled with market panic, she simply increased her contributions again and continued her automatic investing strategy. "But weren't you scared?" I asked Alex when interviewing her for this video. Her answer was refreshingly honest. "Terrified. I'm not some robot without feelings. Every market drop made my stomach turn. The difference was I had a system that didn't rely on my feelings to make decisions." What made Alex's approach work wasn't complex algorithms or special knowledge. She recognized that market crashes aren't anomalies there. recurring features of our financial system. By creating an investment approach that actually benefited from these crashes, she transformed volatility from an enemy into a wealth-building ally. Alex's story shows that success during market crashes isn't about having a crystal ball or nerves of steel. It's about having a system that works precisely when everyone else is freaking out. By automating her contributions and increasing them during downturns, she removed emotional decision-making from the equation. The most powerful part of Alex's strategy wasn't financial, it was psychological. While others saw falling prices as proof the market was broken, she recognized them as a temporary discount on assets that would eventually recover. This fundamental shift in perspective, seeing opportunity where others saw only danger, made all the difference. Jordan's diversification masterclass during market chaos. While Alex embraced market downturns with index funds, Jordan's approach to volatility might make your brain hurt at first, until you see how brilliantly it worked. Would you believe that during the same crash where most investors watched their portfolios nosedive, this graphic designer actually made money on parts of his holdings? His story shows why diversification is your secret weapon when markets go haywire. Jordan wasn't always a diversification genius. At 29, he was just a graphic designer with around $12,000 scattered across 3 random investments his uncle had recommended: a tech stock, a mutual fund, and some shares in his employer's company. But in late 2019, something just felt off. Headlines about trade wars, yield curve inversions, and economic warning signs were piling up. Instead of ignoring these signals like most people, Jordan decided to take action. "I'm not particularly smart about markets," Jordan told me, "but I am obsessive about organizing information. So I figured I'd apply that skill to my money before things got worse." What happened next transformed Jordan's financial mindset completely. He spent an entire weekend with his laptop, a whiteboard, and enough coffee to fuel his financial makeover. He emerged with what his girlfriend called a beautiful mind meets Wall Street, a completely reimagined portfolio approach. Most people think of diversification like ordering just a burger and fries. Jordan went for the full buffet. He split his modest $12,000 across 7 different asset classes: U.S. stocks, international stocks, bonds, REITs, real estate investment trusts, commodities, cash, and inflation-protected securities, an asset class many investors overlook. "My friends thought I was being paranoid," Jordan laughed. "They were all dumping everything into the same 5 tech stocks everyone was talking about. Meanwhile, I'm calculating how these different investments might behave in various market conditions." Then March 2020 hit, revealing the wisdom in Jordan's strategy. While his stock investments plummeted 35% like everyone else's, his bonds gained 5%. His REITs and commodities fell, but less dramatically than the broader market. And those weird inflation-protected securities? They jumped 12% when everything else was tanking. Jordan's strategy focused on how different investments behave during market stress. During crashes, stocks and bonds often move in opposite directions. When one falls, the other might rise. He wasn't trying to predict specific winners. He was creating a system where something would thrive regardless of market conditions. The psychological advantage was even bigger than the financial one, Jordan explained. "While my friends were panic-checking their accounts every 15 minutes and seeing nothing but red, I could see green in parts of my portfolio. It completely changed how I felt about the crash." This mental edge created real financial benefits. When his tech-obsessed friends were too scared to buy anything, Jordan was rebalancing, selling his bonds that had gone up and using that money to buy more stocks at bargain prices. His diversification didn't just protect him during the downturn. It gave him the confidence to be opportunistic when others froze with fear. The results speak for themselves. At the worst point of the 2020 crash, Jordan's portfolio was only down about 12% compared to the market's 35% drop. Even better, he fully recovered his losses in just 7 months, while the broader market took 18 months to recover. "People misunderstand why diversification matters," Jordan told me. "They think it's about minimizing losses. But the real power is that it gives you options during chaos. When parts of your portfolio remain stable during a crash, you can use that stability to buy what's cheap." Jordan's experience demonstrates a fundamental truth. The goal isn't predicting which investments will perform best. It's creating a system where you're positioned to capitalize on unpredictable market movements. By spreading his money across assets with low Correlation to each other, market disaster actually became his opportunity. His approach required more upfront work than Alex's simpler index fund strategy, but offers powerful lessons for anyone worried about market volatility. The assets that performed best weren't necessarily the ones Jordan expected. And that was exactly the point. By creating a portfolio where something would likely thrive in any environment, he removed the need to predict the unpredictable. The hardest part was explaining my strategy to friends and family, Jordan admitted. They'd ask which stocks I was buying, and their eyes would glaze over pretty quickly when I started explaining my approach. But the complexity had a hidden benefit. It made emotional decisions nearly impossible. His rebalancing rules were so clear that there was no room for panic or FOMO. When the market dropped, he simply followed the rules he'd established when his emotions weren't running high. For anyone intimidated by Jordan's approach, the good news is you don't need to become a math wizard to implement a simplified version. The key principles, spreading investments across different asset classes with low correlation to each other and having clear rebalancing rules, can be applied with much less complexity. Maya's tech stock strategy, finding diamonds in the digital rubble. While Jordan's approach relied on spreadsheet wizardry, Maya took a completely different path during the market meltdown. If you've ever watched someone find treasure while everyone else is running from a storm, that's basically Maya's story. Maya didn't have some fancy finance background. She was a 31-year-old marketing manager who'd been squirreling away $400 every month, but was too nervous to actually invest it. By the time 2020 rolled around, she had $22,000 just sitting in her savings account collecting dust, or more accurately, earning a pathetic 0.1% interest. When the pandemic hit and tech stocks were crashing, Maya spotted a disconnect that others missed. Some tech companies were seeing their user numbers absolutely explode even as their stock prices tanked. I kept hearing about how tech was doomed, but then I realized I was using more tech than ever before, Maya explained. My entire life had moved online overnight, and I couldn't be the only one. Instead of fixating on scary stock charts, Maya got curious. She created a spreadsheet tracking which digital services had suddenly become essential. The numbers were eye-opening. Video conferencing usage up 300%, streaming subscriptions jumping 70%, e-commerce platforms seeing 200% more traffic, and cloud services scaling to handle the surge. It was like watching a gold rush that only she could see. This observation led her to create a ridiculously simple system. If a company's stock was down at least 30%, but its actual usage had jumped up by 50% or more during the pandemic, she'd buy it, regardless of what headlines were saying. The disconnect was so obvious once I started looking, Maya said. News anchors were talking about tech companies going bankrupt while literally using those same companies' products to broadcast from their homes. Maya was selective in her approach. She zeroed in on companies with strong balance sheets, specifically those with low debt levels and healthy cash reserves. She knew these companies could weather months or even years of market chaos without running into financial trouble. While her friends were buying whatever random stocks were trending on Reddit that day, Maya quietly purchased shares in 5 specific tech companies that had become absolutely essential to the new stay-at-home economy. One of her picks was Nvidia, which most people just thought of as that gaming graphics card company. Maya had noticed something different. Data centers were suddenly being pushed to their limits as everyone moved online, and Nvidia's GPUs were becoming the backbone of AI applications that were exploding in usage. The company's robust cash reserves particularly caught her eye. She also picked up shares of Alphabet when investors worried about advertising revenue drying up. While others fixated on short-term ad declines, Maya focused on how Google's cloud services were seeing massive growth and how the company was integrating AI across its products. Microsoft was another company on her radar, particularly after she learned about their partnership with OpenAI. Everyone at my company suddenly couldn't live without Microsoft Teams, and Azure was powering all these businesses that had to go remote overnight, she explained. What's wild is that Maya wasn't the only millennial making these moves. Surveys showed that young investors were surprisingly optimistic during this period, with 73% expressing confidence in tech-related investments despite the market volatility. The difference was that Maya focused on the companies with the strongest financial positions rather than just following trends. My friends thought I was nuts for buying when CNBC was running those market in turmoil banners nonstop, Maya laughed. But I wasn't guessing. I was watching what was actually happening in the real world versus what the stock market was doing. The results. Within just 18 months, Maya's $22,000 investment had grown to over $68,000, a mind-blowing 209% return when the broader market was only up about 75%. That initial investment that had been gathering dust in her savings account had tripled in value because she spotted a pattern most investors missed. The craziest part was that I wasn't doing anything complicated, she explained. I was literally just paying attention to which digital services everyone suddenly couldn't live without, and then checking if those companies had enough cash to survive the uncertainty. Maya's approach revealed something fundamental about market crashes. There's often a massive disconnect between a company's stock price and what's actually happening in its business during chaotic periods. When fear takes over, the market temporarily stops caring about user growth, competitive advantages, or even increasing revenue. What makes this strategy so powerful is that you don't need insider information or complex financial models. You just need to pay attention to changing consumer behaviors around you. During market panic, stocks are often priced based on emotion rather than business fundamentals, creating opportunities for observant investors. For Maya, the lesson was about training herself to look for the gap between perception and reality during market chaos. When everyone else was avoiding tech, she was looking at actual user numbers and company balance sheets, not scary headlines. I used to think investing success required some magical ability to predict the future, Maya said. Now I realize it's more about noticing what's already happening that others are too distracted to see. Zach's private market adventure during public market panic. While Maya was spotting tech opportunities hiding in plain sight, Zach discovered something even more fascinating, an entire investment universe that barely registered a blip during the market meltdown. When public markets were in full-on panic mode, he stumbled into a financial realm where the chaos seemed worlds away. Zach, a 27-year-old software developer with about $35,000 spread across his investment accounts, watched in dismay as the market tanked in 2020. But rather than joining the collective freakout, something clicked in his brain. He remembered his former boss mentioning something called private markets during a lunch conversation months earlier. Everyone focuses on what's happening on CNBC, but there's this whole other financial ecosystem most people can't access, his mentor had explained between bites of sandwich. The comment stuck with Zach, and now, with markets in free fall, he decided to investigate. What he found amazed him. Private market investments, startup companies, private real estate deals, and businesses not traded on stock exchanges had been exclusively reserved for the ultra-wealthy and institutional investors for decades. But recently, new platforms had emerged that were opening this exclusive world to regular people like Zach. Instead of panic selling or trying to catch falling knives in the stock market, Zach made a move his friends thought was totally bonkers. He took $10,000, nearly a third of his portfolio, and redirected it into private market investments through these new platforms. "Dude, are you crazy?" his roommate Jake asked when Zach explained his plan. "You can't even sell those if you need the money. What if this gets worse?" It was a fair question. Unlike stocks you can sell with a tap on your phone, private investments often lock up your money for years. In normal times, that illiquidity looks like a major disadvantage. But Zach realized something powerful. During market chaos, illiquidity was actually a superpower. While everyone was obsessively checking their portfolios every 5 minutes and panic selling, I couldn't even log in and see my private investments dropping, Zach explained. And honestly, that was the whole point. Zach had tapped into a fascinating economic reality. Private market valuations don't swing wildly based on daily headlines or Twitter trends. They're typically assessed quarterly based on actual business fundamentals, revenue, growth rates, and profitability, not moment-to-moment emotional reactions. Zach diversified his private market adventure across 3 categories. First, he put $4,000 into equity crowdfunding platforms, buying small ownership stakes in early-stage companies still years away from going public. These platforms had recently become available to non-accredited investors thanks to regulatory changes, part of a broader democratization of investment opportunities. Another $3,500 went into private real estate investment trusts, REITs, that owned apartment buildings and industrial properties. Unlike publicly traded REITs that bounce around with stock market sentiment, These private versions were valued based on actual rental income and property assessments. The remaining $2,500 went into peer-to-peer lending platforms where Zach essentially became a banker, funding small business loans and earning interest payments each month. The results spoke for themselves. When public markets nosedived, Zach's private investments barely flinched. His private REIT actually increased its valuation during the period, as the underlying apartment buildings continued generating rental income regardless of stock market drama. The startups he backed through equity crowdfunding were still quietly building their businesses, completely detached from the market's mood swings. It felt like I'd discovered a secret financial world where the market crash barely existed, Zach noted. My friends were having meltdowns about their portfolios while I was getting regular updates about how my private investments were growing or holding steady. While public markets experienced historic volatility, private market investments demonstrated remarkable resilience. This stability reflected fundamental differences in how these investments are structured and valued. A few of Zach's equity crowdfunding investments did struggle during the pandemic, but others thrived, particularly those providing digital solutions for the sudden work-from-home economy. His peer-to-peer loans continued paying monthly interest, providing a steady income stream when dividend-paying stocks were slashing their payouts. The private equity market, already a $13 trillion behemoth, is projected to grow to over $20 trillion by 2030 according to industry research. This expansion is being fueled by growing accessibility to investors who previously couldn't participate. I used to think private investments were only for billionaires and venture capitalists, Zach said. Now regular people can build diversified private market portfolios with relatively small amounts of money. Over the 3 years following his initial investment, Zach's $10,000 private market adventure grew to $17,300, a 73% return that came with far less emotional turbulence than his public market investments. Even more valuable was the stability these investments provided when everything else seemed uncertain. The experience profoundly changed Zach's investing philosophy. Private markets weren't just an alternative asset class, they operated by entirely different rules. While public markets were dominated by algorithmic trading and sentiment swings, private markets moved to the slower, steadier rhythm of actual business performance. Most people think diversification means spreading money across different stocks or adding some bonds, Zach explained. But true diversification means having money Olivia's hedging different financial ecosystems, making money that don't move together. While Zach found safety in private markets, Olivia took a totally different approach. She embraced the crash head-on. During the 2020 market meltdown, when most investors were losing sleep and money, a small group of everyday investors actually saw parts of their portfolios jump 70% in value. These weren't Wall Street hotshots with fancy degrees. Just regular people like Olivia who understood that sometimes the best umbrella is the one specifically designed for the storm. Olivia wasn't always this financially savvy. As a 33-year-old nurse who had squirreled away about $65,000 through years of careful budgeting, she initially followed the same path as everyone else, dumping most of her money into popular stocks. But in late 2019, something didn't feel right. Trade tensions were escalating, the yield curve had inverted, and economists were starting to whisper about recession possibilities. I couldn't shake this feeling that my all-stock portfolio was like walking into a hurricane without even a raincoat, Olivia told me. Instead of panicking and selling everything, or worse, doing nothing, she decided to try something that seemed completely counterintuitive at first. Olivia set aside 15% of her portfolio, about $9,750, for something called hedging. When I asked what exactly that meant, she laughed and said, "It's basically investments that do better when everything else is doing worse." My friends thought I was crazy. Her college roommate actually messaged her saying, "Isn't that like betting against yourself?" But Olivia saw it differently. I explained it's more like buying insurance for your house. You buy it because if something bad happens, you want protection. Olivia implemented her safety net through 3 strategic approaches designed to thrive during market chaos. First, she put about $3,250 into physical gold and silver. Not just ETFs or paper gold, she emphasized. I bought actual physical metals and stored them properly. During the initial weeks of the COVID-19 pandemic, gold prices surged approximately 12% as investors flocked to safe haven assets. Silver followed with an 8% increase. Holding something tangible that's been valuable for thousands of years feels reassuring when the world seems like it's falling apart, Olivia explained. Plus, it's super liquid. I could sell it immediately if I needed cash. Building on this foundation, Olivia allocated $3,500 to put options on major market indexes. Everyone told me options were too complicated and dangerous, she said, rolling her eyes. But I took an online course and realized buying put options is actually pretty straightforward. These put options gave Olivia the right to sell shares of market index ETFs at predetermined prices. When the market tanked, these options skyrocketed in value. When the S&P dropped 30%, my put options nearly tripled in value, Olivia said. It was wild checking my account and seeing part of my portfolio actually going up while everyone else was panicking. Completing her protective strategy, Olivia invested $3,000 in structured notes with downside protection. These custom-built investment products offered partial protection against market declines while still allowing for some upside if markets recovered. These were perfect for someone like me who wanted protection but didn't want to completely give up on potential gains, Olivia explained. The bank basically promised that if the market dropped up to 15%, I wouldn't lose anything. If it dropped more, I'd only take a partial hit. When March 2020 arrived and markets went into freefall, something almost magical happened in Olivia's portfolio. While 85% of her investments, $55,250, dropped along with the broader market, that strategic 15% in hedging positions, $9,750, jumped by over 70% in value, growing to more than $16,500. My friends were calling me crying about their accounts being down 35%, and I was like, yeah, most of mine is down too, but my hedges are actually making money right now, Olivia recalled. The crazy part wasn't even the financial benefit, it was psychological. I felt so much calmer than everyone else. That psychological advantage turned out to be Olivia's secret weapon. While her friends were paralyzed by fear, Olivia had the confidence to take the next critical step. Because my hedges were doing so well, I actually had extra cash to deploy when stocks were at their cheapest, she explained. I was buying great companies at 30 to 40% discounts, while everyone else was either selling in panic or too scared to buy more. The end result: not only did Olivia's hedging strategy protect her during the crash, but it also positioned her perfectly for the recovery. Over the next 2 years, her portfolio generated a total return of 112%, substantially outperforming most of her peers who either sold at the bottom or sat frozen on the sidelines. The weirdest thing is realizing I actually made more money because of the crash than I would have if markets had just gone up steadily, Olivia reflected. My nurse friends still think I'm some kind of financial wizard, but it was just about having a system in place before everyone else started panicking. Tyler's contrarian comeback, betting against the crowd. Speaking of benefiting from market chaos, have you ever noticed how the investments that terrify most people often deliver the most impressive returns? When Olivia's strategy showed us the power of hedging, Tyler's approach went a step further by running straight toward what everyone else was fleeing from. The most important lesson wasn't even about the specific investments, Olivia had explained. But for Tyler, a 25-year-old accountant, the lesson was about to get much more specific and much more uncomfortable. Tyler had managed to save about $18,000 through careful budgeting and living with roommates after college. When the 2020 crash hit, he watched as nearly 40% of his hard-earned money evaporated in weeks. Unlike our other investors, Tyler hadn't prepared a strategy beforehand. I remember staring at my phone, watching the numbers drop every day, Tyler told me. This shock became his turning point. Instead of giving up, Tyler's anxiety drove him to research. He stumbled across an old book about contrarian investing at a used bookstore, a strategy built around Warren Buffett's famous advice to be fearful when others are greedy, and greedy when others are fearful. The concept clicked for Tyler immediately. Everyone was piling into the same handful of tech stocks, paying crazy prices just because they felt safe. Meanwhile, entire industries were being priced like they were going bankrupt tomorrow. In April 2020, while most investors were either hiding in cash or chasing tech stocks, Tyler created a simple but powerful system. Identify the most hated sectors of the market, research which companies in those sectors had the financial strength to survive, then buy them when nobody else would touch them. I started with a list of the 3 sectors everyone was saying might never recover: airlines, hotels, and energy. When I heard CNBC analysts saying things like airlines might never see pre-pandemic passenger numbers again, that's when I got really interested. Tyler's screening system was surprisingly sophisticated for someone with no finance background. Companies with enough cash to survive at least 12 months with zero revenue. Manageable debt levels, especially with no major loans coming due soon. Strong market positions before the pandemic hit. Using public financial statements, Tyler identified 2 airline companies that met his criteria. Delta Airlines stood out with its $15 billion in liquidity secured through loans and grants. While they reported losses exceeding $10 billion in 2020, their balance sheet showed they could weather the storm. In the hotel sector, Marriott caught his eye. Their occupancy had crashed to around 20%, but they had the financial strength to survive, and I believed people would eventually want to travel again. For energy companies, Tyler focused on those with diverse operations rather than pure-play shale producers. I bought ExxonMobil when everyone thought oil demand would never recover. Their stock had been absolutely hammered, but their balance sheet was still relatively strong. While his friends were loading up on popular tech stocks, Tyler quietly invested about $12,000 of his remaining funds across these beaten-down sectors. Roughly 40% in airlines, 20% in hotels, and 40% in energy companies. Like a sailor steering into the heart of a storm rather than away from it, Tyler faced intense psychological challenges. These stocks kept dropping for months after he bought them. Headlines screamed about potential bankruptcies and permanent changes in travel behavior. I doubted myself constantly, Tyler admitted. Every day the stocks dropped more, I'd think, what if everyone else is right and I'm just being stubborn? What kept him going was his growing understanding of market psychology. I realized most investors were making decisions based on headlines and emotions, not fundamentals. They were extrapolating the pandemic situation forever into the future. By mid-2021, the first signs of recovery emerged. As vaccination rates increased, Delta began reporting improved bookings. By summer 2022, the airline posted its first significant post-pandemic profit, $1.4 billion in the second quarter. Marriott's occupancy rates climbed back to around 70%, up dramatically from pandemic lows. And ExxonMobil reported staggering profits of $23 billion in 2022 as energy prices recovered. The turnaround was almost surreal, Tyler recalled. The same stocks everyone called uninvestable in 2020 were suddenly everyone's favorites again. By mid-2022, Tyler's contrarian portfolio had generated a 187% return. His $12,000 investment had grown to nearly $34,500. This dramatically outperformed both the S&P 500 and his friends' tech-heavy portfolios, many of which were suffering as the tech sector began to cool. What made Tyler's approach particularly effective wasn't just picking beaten-down sectors. It was his focus on financial strength within those sectors. The pandemic was basically a real-world stress test that separated the strongest companies from the weakest. The experience transformed Tyler's investment philosophy. I realized contrarian investing is about recognizing when market psychology has disconnected from business reality. The most important lesson? Extreme fear creates extreme opportunities. When an entire sector gets crushed, even the strongest companies get dragged down with the weakest ones. That's when you can find incredible bargains if you're willing to look deeper than the headlines. The psychology playbook, mental tricks that made the difference. Looking beyond headlines was just one piece of Tyler's success puzzle. His secret weapon was actually a set of psychological hacks. What if I told you that the world's most successful investors aren't necessarily the ones with the best strategies, but the ones with the strongest mental game? There's a reason why Warren Buffett calls temperament more important than intelligence when it comes to investing. I've got to be honest, the strategies our 5 investors used were totally different, but they shared something way more important than their investment picks. They had psychological superpowers that kept them calm while everyone else was freaking out during market chaos. When we sat down with Alex, Jordan, Maya, Zach, and Olivia, we expected to hear about complex investment formulas. Instead, they kept circling back to specific mental techniques they used to manage their emotions when the markets went crazy. These weren't vague, stay positive mantras. They were actual psychological practices they used daily during the worst market meltdowns. Think of these techniques as their investing playbook, just like how pro athletes have specific plays for high-pressure situations. Howard Marks, one of the smartest minds in investing, puts it perfectly. You can't be a good investor if your emotions dominate you, because then you'll make the same mistakes as everybody else in the market. Our 5 investors created their own psychological playbooks with these game-changing techniques. The Panic Journal. Alex, she wrote down her worst market fears in a notebook, then revisited them 30 days later. On March 18, 2020, I wrote that I was terrified the market would drop another 50%, she told us. The reveal. Almost none of her catastrophic predictions came true, training her brain to recognize how anxiety exaggerates reality. Financial fire breaks. Jordan, similar to gaps in forests that prevent fires from spreading, Jordan avoided checking his portfolio more than once a month during crashes. Every time I felt the urge to log in, I'd write the date in my calendar instead. If it wasn't my monthly check-in day, I'd force myself to wait. This simple rule prevented the emotional roller coaster of watching daily drops. Reverse FOMO. Maya, she flipped market fear into excitement by keeping a detailed list of quality companies she wanted to buy at discount levels. I had a spreadsheet of about 20 companies with specific price targets. Like if company X dropped below $Y per share, I'd buy immediately. This transformed crashes from scary events into exciting opportunities. Scenario planning. Zach, before the crash even started, I wrote down exactly what actions I'd take if the market dropped 20%, 40%, or 60%, he explained. By pre-committing to specific actions, he eliminated emotional decision-making when things got rough. When the market tanked, he simply followed his plan like a recipe. Emotional versus system money. Olivia, she created 2 distinct portfolio buckets. I allowed myself to make reactive trades with just 5% of my portfolio, my emotional money, she told us. The other 95% was system money that operated on autopilot with strict rules. This satisfied her need to do something without risking her financial future. Together, these techniques create a complete psychological toolkit that transforms how you experience market volatility. They're like emotional circuit breakers that prevent panic from short-circuiting your financial plans. What's fascinating is how these psychological techniques aren't just nice extras. They're the essential foundation that makes investment strategies possible. The best investment plan becomes useless if you panic and abandon it halfway through, which happens to most people during market meltdowns. Research backs this approach too. Behavioral finance experts have identified several psychological traps investors commonly fall into, like the anchoring trap and the sunk cost trap. Our 5 investors developed specific defenses against these mental mistakes, allowing them to maintain a long-term perspective when others couldn't. I was particularly struck by Maya's cocktail party test. At the height of the 2020 crash, I went to a dinner where everyone was panicking about their portfolios. I realized I was the only person at the table who wasn't stressed about the market. That's when I knew my psychological tools were working. This is the opposite of what economists call cocktail party investing, where people make decisions based on what everyone else is talking about. Studies show that investors who limit how often they check their portfolios, like Jordan with his monthly check-ins, experience better risk-adjusted returns compared to frequent checkers. Meanwhile, Alex's Panic Journal operates like a cognitive behavioral therapy technique, helping identify negative thoughts and replace them with realistic assessments. Writing down my fears forced me to articulate exactly what I was scared of, which immediately made those fears less powerful, she explained. The real power in these tools isn't just preventing bad decisions. They actually transform market volatility from something terrifying into potential opportunity. Zach summed it up perfectly. Once I had my scenario planning in place, I started almost looking forward to market drops. Each decline meant I could activate the next phase of my pre-planned strategy. The crash pattern playbook, signals that predicted recovery. Those mental strategies were just half the equation. What if I told you that market crashes actually follow predictable patterns that signal exactly when to start buying? Our 5 investors weren't just guessing when to jump back in. They were quietly tracking specific indicators that have appeared in every major market crash, while most people were still panic selling at the worst possible time. When we dug deeper into how these 5 ordinary people managed to time their purchases so effectively, something fascinating emerged. They were watching for specific recovery signals that historically appear before markets turn around, like pieces of a puzzle coming together to reveal the bigger picture. Think about market crashes as storms in the financial weather system. First comes the lightning, shocking headlines, then thunder, price drops, followed by heavy rain, panic selling. But our investors knew storms eventually pass, and they watched for those first clearing signs while everyone else was still hiding under umbrellas. I wasn't trying to guess the exact bottom, explained Tyler. I was looking for proof that the extreme fear was starting to fade. When the VIX finally started dropping for nearly a week straight, that was my green light to start buying the airlines and energy stocks nobody wanted to touch. The VIX, that fear index that spikes during panic, was the first piece of their recovery puzzle. But our investors were collecting multiple puzzle pieces before making moves. The second piece? Market divergence. During the 2020 recovery, they noticed that strong companies stopped falling as quickly as the broader market. Maya pointed this out. I noticed some tech companies were down 30% from their highs, but they'd actually been flat or slightly up for about 2 weeks while everything else kept tanking. That divergence was my signal to start buying, even though everyone was still freaking out. Insider buying patterns formed another crucial piece. When company executives purchase their own stock during market turmoil, it signals confidence in their company's future. When I saw the CEO of that hotel chain purchase $2 million of his own company's stock in April 2020, I knew it was time to follow his lead, Jordan explained. Who knows more about a company's real prospects than the people running it? They were seeing something positive that wasn't reflected in the stock price yet. For more technically minded investors like Olivia, credit spreads provided additional confirmation. These spreads measure the difference between corporate and government bond yields, essentially showing market confidence in businesses. When I saw credit spreads start to narrow in late March 2020, I knew the financial system was beginning to stabilize, even though stock prices were still ugly. That's when I started deploying my cash reserves into stocks. Extreme investor sentiment, when surveys show overwhelming pessimism, worked as another reliable indicator. When nearly everyone who wants to sell has already sold, there are few sellers left to push prices lower. I subscribed to this investor sentiment survey, Alex told us, and when it hit extreme pessimism levels in March 2020, I actually increased my 401k contribution. History shows that when everyone is super negative, the market is usually setting up for a rally. Even asset correlations provided valuable clues. During market downturns, gold typically becomes a safe haven while stocks crash. When I saw gold prices surge about 12% in the early weeks of the pandemic while everything else was crashing, I recognized it as part of the normal fear cycle, Zach explained. But I also knew from studying previous crashes that when gold starts underperforming again relative to stocks, it often means the recovery is beginning. The magic wasn't in any single indicator, but in how these signals clustered together, like multiple instruments in an orchestra beginning to play in harmony after a period of chaos. None of our investors waited for every single signal to align perfectly. Instead, they started gradually buying when 3 or more signals confirmed each other. This signal-based approach gave them something invaluable during market chaos: confidence. While their friends were paralyzed by uncertainty, our 5 investors had concrete indicators telling them when to act. The best part about watching these specific signals is that I didn't need to rely on gut feelings or CNBC pundits, explained Olivia. When I saw multiple indicators pointing in the same direction, I could buy with confidence even though it still felt scary. Their approach challenges the idea that nobody can time the market. While predicting exact tops and bottoms remains impossible, recognizing these recovery patterns allowed our investors to start buying within weeks of the actual market lows, capturing enough upside to dramatically outperform those who waited for certainty. The truly fascinating aspect is how these patterns repeat across different eras. The VIX behavior appeared in both 2008 and 2020. Credit spread narrowing preceded recovery in multiple crashes. Insider buying spiked near market bottoms consistently. These aren't coincidences. They're human psychology playing out in market dynamics, creating similar patterns that savvy investors can recognize, building your crash advantage. Option 2's framing perfectly captures what we need to focus on. Those market signals are fascinating, but they're practically useless unless you're prepared to act when everyone else is losing their minds. Let's build on that insight. These patterns we've been examining are your blueprint for building wealth during chaos. But here's the uncomfortable truth most financial experts won't admit. Knowing about these signals is worthless unless you have a system ready before the market tanks. Ever notice how crystal clear your thinking is when markets are stable, but how your brain turns to mush when your portfolio drops 30%? That's exactly why building your personal crash toolkit now, while your emotions aren't clouding your judgment, is essential. Our 5 investors didn't stumble into success. They each created specific game plans long before market chaos hit. What does your plan look like? Let's be real, the absolute worst time to figure out your investment strategy is when you're freaking out about your shrinking portfolio. Your brain literally can't access its rational decision-making processes in panic mode. That's why we need to build your opportunity hunting system today, not when the market is already in freefall. Here are the 5 essential elements that will transform you from a panic seller into an opportunity hunter. 1. Create your crash budget. This is money deliberately set aside specifically for buying during downturns. Strategic investors typically maintain 15 to 20% of their portfolios in cash or cash equivalents for this purpose. Think of this cash as your opportunity fund that positions you to provide liquidity when others are desperate, at a premium, of course. Having this predetermined means you won't be scrambling to figure out how much you can afford to invest when prices drop. 2. Build your detailed watch list. You need a shopping list of 10 to 15 quality companies with specific buy points for each. Create trigger points like, I'll invest 25% of my crash budget in Apple if it drops to $X, another 25% if it hits $Y. Your watch list should include notes on why each company deserves a spot, their competitive advantages, financial strength, and growth potential. This detailed preparation ensures you'll focus on quality when everyone else is panicking about price movement. 3. Establish your diversification framework. Determine exactly what percentage of your portfolio should be allocated to each asset class. Consider international exposure, different sectors, alternative investments, and various risk levels. Include specific rules for when and how you'll rebalance during volatility. This framework acts as your investing constitution, telling you exactly how much to buy to restore your desired allocation. No emotion required. When your tech stocks suddenly drop 40%, your framework gives you clear direction. 4. Create psychological circuit breakers. These are specific rules preventing emotional decisions during market stress. Limit portfolio checks to once monthly during downturns. Research shows this significantly improves returns by preventing panic selling. Document these rules clearly. I will not check my portfolio more than once per week during corrections, or I will consult my investment journal before selling during downturns. These aren't just suggestions. They're commitments to your future self when emotions threaten to derail your strategy. 5. Establish personal opportunity signals. Choose specific market indicators that tell you when to deploy your crash budget. Don't rely on gut feelings or headlines. Will you watch for VIX patterns? Credit spread changes? Insider buying surges? Create a chaos checklist outlining specific actions at different market decline levels. At a 10% drop, deploy 20% of your crash budget. At 20%, another 30%. This transforms emotional responses into systematic actions, dramatically reducing your stress during downturns. When you combine these 5 elements, a crash budget, detailed watch list, diversification framework, psychological circuit breakers, and opportunity signals, you create a comprehensive system that works precisely when most investors' decision-making breaks down. This preparation is transformative. In the 2020 crash, research showed that 78% of investors who claimed they planned to buy the dip never actually pulled the trigger. Their emotions overrode their intentions. But investors with predetermined systems acted decisively, buying quality assets at massive discounts. Remember, market crashes aren't rare anomalies. They're inevitable features of a healthy financial system. The question isn't if another crash will come, but when, and whether you'll be prepared to use it as the wealth-building opportunity it truly is. Applying these lessons today, current market opportunities. Option 3 resonates perfectly with what we're seeing in the market right now. Look at what's happening in early 2025. The warning signs are flashing right in front of us. While everyone's debating whether we're headed for a full meltdown or just a correction, The smart money is already positioning for specific opportunities that mirror what our 5 investment heroes did. Remember their strategies? They're showing up again today, but with crucial twists for our unique market conditions. How exactly are these patterns creating 5 specific opportunity zones that match our case studies? Let's start with the AI sector. The Magnificent 7 tech giants, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, currently make up 35% of the S&P 500's market cap and have driven over 70% of its returns since 2023 began. Sound familiar? This creates the exact scenario Maya capitalized on. These top 10 S&P stocks are trading at 29 times forward earnings, while the rest of the market sits at just 19 times. What would Maya do in today's market? She'd identify the disconnect happening in specific AI subsectors where promising companies are getting dumped during volatile trading days. Remember how she looked for improving business metrics while stock prices dropped? That same pattern is emerging again, but how many investors will recognize it before prices rebound? The second opportunity zone mirrors Tyler's approach with small cap value stocks. With interest rates climbing, smaller companies have been hammered, creating the exact kind of contrarian setup Tyler would love. These companies are trading at historic discounts compared to larger counterparts. But has anyone noticed while they're obsessing over AI stocks? Tyler focused on fundamentally sound businesses in hated sectors. Exactly what we're seeing in today's small cap value space. Many solid businesses are trading as if they're going bankrupt when their balance sheets tell a completely different story. The question is, can you spot these opportunities while everyone else is fixated on flashier headlines? The third opportunity zone has evolved dramatically since Zach pioneered private market investments. According to recent surveys, 83% of CEOs and 87% of investors expect increased M&A activity in 2025, driven by more favorable financing conditions. What's changed since Zach's time? The barriers to entry have collapsed. Regular investors can now participate in equity crowdfunding, private REITs, and peer-to-peer lending without needing accredited investor status. The illiquidity premium Zach loved, investments that don't swing wildly with public sentiment, is now available to almost anyone willing to learn. How would Zach adapt his strategy to these new platforms and opportunities that weren't accessible to average investors during his time? The fourth opportunity requires adapting Olivia's hedging strategy for today's environment. Precious metals are behaving differently in this inflationary climate than in previous downturns. Gold continues attracting investors seeking stability during market uncertainty, but with a modern twist that Olivia would find fascinating. For Olivia's strategy to work in 2025, would she focus on structured products that specifically account for inflation risks alongside market volatility? The principle remains, having assets that zig when markets zag, but the specific instruments need updating to match today's economic reality. How would she refine her approach given these new market dynamics? The fifth opportunity wasn't even on our case study's radar: international market divergence. For the first time in ages, there's a massive valuation gap between US markets and the rest of the world. European markets and emerging economies are trading at significantly lower multiples than American counterparts, creating a global opportunity set that wasn't available during previous US-centric crashes. This means you can apply all 5 strategies: Alex's index buying, Jordan's diversification, Maya's fundamental analysis, Zach's private markets, and Tyler's contrarian approach, with an international twist that wasn't as accessible before. The global financial system now makes these opportunities available through low-cost ETFs, international brokerages, and fintech platforms. Which of our 5 heroes would adapt most quickly to this global opportunity? What makes these opportunities powerful isn't that they're guaranteed winners. It's that they represent systems for identifying value when others are blinded by fear or greed. By recognizing patterns instead of reacting to headlines, you position yourself ahead of the crowd. Consider AI stocks. Are you simply riding momentum or panicking about a bubble? A Maya-inspired approach would have you looking for companies where AI adoption metrics are improving dramatically while stock prices pull back on temporary concerns. Or with small caps. While TV pundits debate whether the Magnificent 7 can continue dominating, a Tyler-inspired approach would have you methodically screening for strong, balanced sheets in overlooked sectors, creating a watch list for when fear spikes. These strategies don't predict the future. They create frameworks for acting rationally when everyone else is emotional. In today's increasingly volatile market, which approach resonates most with your investment personality? The ultimate mindset shift, from market victim to opportunity hunter. Option 2 speaks to exactly what we need to focus on right now. While frameworks and strategies are great, the real game changer is what's happening between your ears during market chaos. The beauty of these strategies is that they create frameworks for acting rationally when everyone else is emotional. In today's increasingly volatile market, emotional decision-making poses serious dangers to your financial health. Let's be real though, knowing what to do is only half the battle. The other half? Actually doing it when your portfolio is melting down and everyone around you is freaking out. This is where most investors fail, and it's not their fault. Our brains are wired to make terrible investment decisions during market chaos. When you see red across your portfolio, your brain triggers the same fight or flight response your ancestors used when facing predators. Stress hormones flood your system, your rational thinking part takes a back seat, and suddenly selling everything feels like the only choice. But this is exactly where our 5 investors separated themselves from the crowd. They had psychological systems that bypassed their brain's default settings. Howard Marks, one of investing's greatest minds, puts it perfectly. The most important thing is controlling your emotions. Not picking the right stocks, not timing the market, controlling what's happening inside your head when uncertainty strikes. So how do we rewire our investing brain? It starts with understanding that uncertainty is the rule in investing, not the exception. Markets will always be unpredictable. The goal is to transform how we respond to it. Let's look at practical mind hacks that can turn emotional responses into strategic advantages. First, practice the what's on sale reflex. When headlines scream about market drops, train yourself to automatically ask, what quality assets are discounted today? This shift transforms your relationship with volatility. Imagine walking into your favorite store and discovering everything's 30% off. Exciting rather than terrifying. Second, measure fear objectively. Emotions feel overwhelming because they're fuzzy and impossible to quantify. Tracking specific fear indicators like the VIX alongside your investments lets you override emotion with data. When panic reaches levels that historically signal buying opportunities, you can make clearer decisions. Third, create a chaos checklist. This specific document outlines exactly what actions you'll take at different levels of market decline. For example, if the market drops 10%, I'll invest 25% of my cash reserve. At 20%, another 25%. By deciding these actions in advance, you're borrowing rationality from your calm self to guide your future panicked self. Did you know that 91% of investors make emotional decisions they later regret during downturns? Your chaos checklist transforms knee-jerk reactions into methodical decisions, similar to how pilots use emergency procedures rather than instinct during crises. Fourth, practice visualization with a twist. Deliberately picture how you'll feel 3 to 5 years after buying quality assets during market panics. This mental time travel is like flipping on a light in a dark room of anxiety. Suddenly, you can see beyond the current chaos to the opportunity it presents. Another powerful technique is developing second-level thinking. Most investors stop at "the market is crashing, I should sell." Second-level thinking asks, what do most investors believe right now? Followed by, what might they be missing? It's like having X-ray vision that sees through market panic to the value underneath. During market chaos, first-level thinking says, everything is terrible. Second-level thinking asks, are fundamentally sound companies being sold alongside troubled ones? This mental habit helps you spot disconnects between price and value. These psychological techniques form the foundation that makes investment strategies possible. The most sophisticated approach is worthless if abandoned during a market storm. Behavioral finance has identified several cognitive traps: anchoring, fixating on previous prices, sunk cost, holding losing positions too long, and confirmation bias, seeking only information that supports existing beliefs. Our case studies didn't magically avoid these pitfalls. They built systems to work around their psychological weaknesses. Studies show successful investors during crashes aren't necessarily those with the best analytical skills. They're often those with the best emotional regulation. They experience fear like everyone else but act. Despite it, think of market volatility like weather. You can't control it, but you can control how you prepare and respond. Most investors waste energy trying to predict exact market moves instead of building all-weather psychological systems. The transformation from seeing market drops as disasters to seeing them as opportunities develops through practice. The more you exercise these mental muscles during small fluctuations, the stronger they'll be when major volatility hits. Remember that visualization exercise? Imagine it's 3 years after a crash, and you're looking at your substantially recovered portfolio. You're explaining how you bought quality assets on sale while others panicked. This mental rehearsal primes your brain to associate market drops with opportunity rather than danger. So here's the takeaway that might just change your financial future. Our 5 millennial investors weren't financial prodigies with trust funds. They recognized patterns that matter and developed the emotional toolkit to act when others froze. Remember Bisembinder's research. Only 2.4% of companies generated all $75 trillion of wealth in global markets over 3 decades. As Jeff Witz puts it, successful investors block out the surrounding noise and follow your investment strategy in volatile markets. Consider precious metals too. They've historically hedged against economic uncertainty. The wealth-building opportunity in market chaos is available to anyone prepared. Don't wait for the next crash. Market volatility is an if, but when, and with preparation, you'll transform chaos into opportunity just like our ordinary millennials did.